All right, welcome back. If you've just joined us, this is Taking Stock. I'm not Pim Fox. I'm Brian Sullivan. He's on vacation. I'll be with you all this week and next as well. We are back. Literally got physically kept here. And Jack Hidary, chairman of Gemstone Capital Advisors, the one who did it. We appreciate Jack and David, you sticking around. I believe, Counselor, you were asking the question. What do you got?
I wanted to get David's view in terms of the new 10-year low on housing starts. We're down now to an annualized rate of 1.38 million starts. What do you see as the consequence of that within the housing industry, but also beyond that, in terms of real estate in general and beyond that?
Jack, it's been tough within the housing industry. It's been very tough on the housing stocks. They went from 100 to 1,200 in 4 years, dropped to 600, bounced to 800. They're now about 450. So they're way down. They're down 60% from the peak. They're down about 40% this year. It's going to be tough because new housing starts, you've got to move it. If Jack is sitting on a home and can't sell it, you just stay with it. But to move it, they've got to have the inventory. The thing you've got to watch, and I would say to your viewers, Brian, they've got to watch three things: jobs, jobs, interest rates,
like employment.
Jobs, interest and profits. And the jobs are the numbers that are going to tip us over or not tip us over into recession. So far, we've been hanging in there about 100,000 a month. In the financial markets, you want to watch interest rate spreads, you want to watch the dollar and gold, you want to watch volatility and Fed actions, not Fed words or Fed
or
free reserves.
Fed inactions?
Fed inaction is an action, and they say we got it under control. Let's let this thing play out a little bit. Let's not throw more gasoline on fire. That's what we've been criticized for. I am so glad. Listen, Alan Greenspan came in 1979. Excuse me, that was Volcker, 79, in August. October of 79, they had the interest rate massacre. Alan Greenspan comes in August of 87, and in October of 87, they have the crash of 87. Bernanke's had 16, 17, 18 months to run a very, very nice Fed, and I think he's done an outstanding job restoring credibility, and he doesn't want to peter that away or piddle that away with a quick interest rate crash out.
Brian, one of the reasons why I think this is a good piece of news, agreeing with David, is that many of these subprime mortgages were not necessarily given by Countrywide or other lenders. They were given by the builders themselves. So in other words, it was customer financing. You had a lot of subprime loans given by Lennar, by other builders themselves, giving the financing, getting into the mortgage game themselves because they wanted that extra profit. So not only did they get profit on the house, they wanted profit on that subprime mortgage. Now that housing starts have come down, I think it's a really good correction for this economy. It's overdue by about 6 or 9 months.
Well, I'll tell you what, we're going to say goodbye to David. David, you stuck around for a long time. I appreciate it, man.
Thank you.
Great job. Great job.
Thank you very much.
We're going to keep Jack Hidary around. We got a lot to talk about with hedge funds. They're a big part of what's going on. Jack's got some charts about what hedge funds are doing well and just what hedge funds are doing, period. Taking Stock returns right after this. All right, we are back with Jack Hidary, chairman of Gemstone Capital Advisors, talking about hedge funds here. Jack, thanks very much. You've got a chart here, actually, or at least a graphic, and we just made it into a graphic for the TV viewers, about which hedge funds over the past year around the world, and there's 2,300 plus funds being sorted, are the best performers. And it's not a hard trend to spot, even for the uneducated like myself.
What do you see here, Brian?
Well, don't bring this up. We got a full-screen graphic that I just put in. We'll bring that up because that's like about a billion, 8-point font. Can't read it.
It's going to be a test
there
for
it is.
the
There it is. There it is.
Yeah. So basically what you have is that despite all the roiling in the current markets, you basically have the emerging market funds. You see a lot of China funds. If you look at the top 50, it's China, it's Brazil, it's some of the India funds, have really been the best performers in terms of the hedge fund space. Just kind of put everything in context. In terms of back here domestically, when we look at some of the funds that have been in the news recently, we talked about Renaissance, Jim Simon's fund, down 9%. Looks like it's made up a lot of that ground in terms of quant strategy. The Goldman Sachs Quant Fund, down 27%. Of course, a $3 billion infusion into that fund. And then Highland, bought in part by J.P. Morgan, down 18% over there. And you have a lot of other funds as well, a lot of the quant funds down.
Yeah, there's so many names. I'm trying to find a couple of American funds that are doing very well. I know that Heyman Capital out in Dallas, run by Kyle Bass, Paulson and company, they've got that. We're going to benefit from the subprime debacle strategy by buying swaps. Are those the best performing types of funds now?
High volatility markets are one of the best times for hedge funds. Hedge funds cannot make money in low volatility times. And so those funds that are well positioned now in terms of having some cash on the books, having some good positions, are able to actually capitalize this. One of the funds that I work with, about a $2.5 billion fund focused on credit opportunities, is now in the market buying up portfolios of mortgages and other types of loans.
They're
30 cents on a dollar, 40 cents on the dollar.
It's basically a distressed fund at this point, then.
Exactly. So this is an opportunity for hedge funds. It's also an opportunity for hedge fund investors, for the endowments, pension funds, funds of funds, and individuals to find out how correlated their hedge fund investments are with beta, with the marketplace. What you want as an investor is a broad view of both correlated and non-correlated assets in your hedge fund portfolio. Now's the time to test your hedge fund portfolio.
Okay, because the point I was bringing up, too, about Paulson and Heyman and those funds that are benefiting from subprime's rout, because we talked about Bear and Goldman, and they've been hit by the rout, but there's other funds. I mean, is it a zero-sum game in some respects? I mean, if long funds are getting smacked, then maybe the short-focused funds are doing well. Does it all net out?
Well, actually, it doesn't have to net out necessarily because you have other asset classes beyond hedge funds. And so this is not necessarily a zero-sum just within the hedge fund space. The hedge fund space, let's remind ourselves, has grown to $1.7 trillion in assets in the last 2 years. $1 trillion 2 years ago, $1.7 trillion today, over 9,000 funds. So sure, among 9,000 funds, we'll have a few.
9,000. So there's more hedge funds than stocks.
Stocks about
publicly available stocks in America.
10,000 publicly available, including micro caps. About 9,000 hedge funds. Yeah, sure, you can have a few failures. Of course, among 9,000 a few failures. You'd be surprised if you didn't.
You know, we talk about quant funds a lot, and people at home who may not be familiar with hedge funds think, what in the world is a quant fund? Basically, you're talking about computer models, computer-driven trading, etc. Do you think the quants out there, the math wizards, are learning that you have to have human intervention? I've talked to quant fund managers. I'm like, who's overseeing this machine?
Look, the thing about quant strategies is they always work until they don't. That's the thing about quant funds.
And when they go wrong, they go wrong. I mean, how do people get in and change the models or say, forget the models? In this environment, are models working?
Models, again, work under a certain set of circumstances. What you have to do is have the humans understand when to use that model. That's where the human comes in. If you want to be part of a quant fund, you want to ask the question, do the humans have control which model is used when? That's what you want to ask as an investor.
The second most read story in the Bloomberg terminal today, Moody's warning that we could be in for another long-term capital management style hedge fund collapse. Now, listen, you can say what you want about the bear funds, maybe Goldman Sachs having their woes. Those are now about as big as LT. You know, we look back at LTCM now. What a little puny fund. I could have raised that money overnight. You know what I mean? But back then it was gigantic. Got some much bigger funds now, right? What is Renaissance? $29 billion bucks.
That's right. We have over 100 funds today with more than $1 billion. More than 100 hedge funds today with more than $1 billion under management.
You know, I just hate headlines like this, though. Potential, possible, maybe, could. I mean, anything's potential. Anything's possible. Do you think, Jack, we will see a $5+ billion hedge fund blow up?
Look, we're going to see some unraveling. We're going to see some liquidations, and that is a normal part of this market. We should see some of those because some people will take different kinds of risks, and they'll be rewarded or punished based on that. But among 9,000 funds, we're not going to see widespread calamity.
Put on your professor, tell us what the next hedge fund strategy is that's going to work. It was convertible ARB. You know, then it was CDOs. Obviously, now it's betting against subprime. What's next? What's going to work now?
Well, again, look at the emerging market, the macro guys. The macro guys are out there. Look at some of the volatility in the FX spot and futures today. If you saw what the yen did, going from 117.
Currency hedge funds are the place to be.
Well, again, macro in general. So macro really encompassing both the emerging market as well as some of the macro currencies. You want to look at some of the possibilities of having the volatility there drive some of the return. A lot of the traditional long-short funds that are called long-short funds are really just long-only funds today. If you actually query them, if you actually look into their portfolios...
They're short one stock and long 99.
Exactly. So really, they're just betting all the way up. That's all they're doing. They're not really hedged. So the term hedge fund really is a misnomer for thousands of the hedge funds that are out there.
All right, Jack Hidary, good stuff. Gemstone Capital Advisors talking about hedge funds. What's working? We know this. China's been working. Of course, I'll bet you those are just long-only funds. As the market goes up in Shanghai, buy domestic bank. All right, Jack, good stuff. Thank you very much.